Hello viewers, it's another fantastic time with Easy Learning Virtual Classroom for Business Management. Lovely friends, take your books, your pens and let us start the process. It is undeniable fact that you experience a greater joy and peace when you and your loved ones are financially stable. To this end, the easy way to manage your resources from trauma associated with risks such as accident, fire outbreak, theft cases is to share your risks with risk management entity. This leads us to our topic as insurance. The exigency of our time calls for more proactive measures like savings against any unforeseen occurrence. In this way, insurance is seen as one of the best options. So, going to focus on insurance. We have the following objectives. The first one is meaning of insurance. The second, list at least one importance of insurance. And then third, differentiate between insurable risks and uninsurable risks. Then the fourth, state how insurance operates. And then the next one, principles of insurance. What insurance is all about? What insurance is all about? Insurance is defined as a process whereby insurance company provide guarantee for compensation for a specified loss, damage, illness, or death in return for a specified premium. It means a pool of risk, which means that the individual's organization spread the probability of risk with other insurance company by making regular payment to the insurance company upon agreed policy. In simple words, it means that insurance is a contract between the insured and the insurer, where the insured agrees to pay periodic premium to the insurer. So in case the insured suffer any loss, the insurance company will come in to compensate the insured. What's more, importance of insurance? The very first one, it's offer unique protection to business, such as fire outbreak, theft cases, and accidents. So it means when you take a policy, you can have protection against eventuality such as fire outbreak, theft cases, and accidents. Then second, it remove insecurity from business. With these entrepreneurs are free to carry out their business without any threat or fear. The third point is life assurance provide mode of savings for individuals or their beneficiaries. So when you take life assurance policy, it's just serve as investment for you and your dependents. The next, it provides health support to the individuals. For example, you have national health insurance. So with this, it means that when you are sick and get to the hospital, you're going to be offered medical support. Then, last but not least, is it protects child education. If you take any policy related to child education, when the time is due, the insurance company will come in with compensation. The next thing to consider is insurable risks. Insurable risks. What are some of the insurable risks? Or what is it? These are risks in which the insurance company can insure, and its prospective claims can be calculated upon its occurrence. So we talk about pure risk, for example. Talk about fire, theft, health, and embezzlement. All these are insurable. What are some of the basic characteristics? The very first one, loss must be unintentional. This means that loss must be by accident. Two, probability of loss must be predictable. This means that outcome can be predicted. Then the next one, measurable with respect to time, amount, and place. This means that the outcome can be quantified in terms of money with respect to time and place. The premium must be within the range of the insured. This means that the insured should be able to pay the premium. It should be economical. So we have a 9 scene here. Buildings here are insurable. The premises are insurable. we have the class they are insurable. So we look again at uninsurable risks. These are risks in which insurance company cannot insure, and its prospective claims cannot be calculated upon its occurrence. What are some of the characteristics? Probability of loss is not calculable. This means that it cannot be calculated. Probability of loss is not predictable. The outcome cannot be predicted. The next, it is not measurable with respect to time, amount, and place. It can't be measured in terms of money with respect to time and then place. And the last but not least, it's sometimes out of business control. You cannot control it. For example, you have acts of nature. So first thing here is uninsurable. Volcanic eruption is uninsurable. Tsunami is uninsurable. How can individual take a policy? Interested person will make inquiries about the products of the insurance at their various premises. Then the policy taker will be given a proposal form to be filled with all relevant information and signed. Upon acceptance of the proposal form, the insurer will issue out insurance policy. The policy spells out the terms and conditions of the insurance. Then the insured will pay premium to the insurance company, and then you'll be given a cover note, that is a temporary certificate. At organization level, we're going to look at insurance market. Insurance market is a process for prospecting for new clients or customers or introducing new products to attract new customers or existing customers to take insurance policy. What are the steps? The very first one, introducing your product to your target market. What's the definition of your target? What are some of the characteristics of your target market? So you need to define your target market. Then the kind of policy that the company has, you need to also explain it to them. Then you move on, you talk about tagging your unique price to the product. So give your price list to them based on the policies. Then you promote your new product or promote your products by giving them product benefits, education, and then information. So you need to give them enough information about the product, education about the product, and its benefit importance to the clients. Then when it's accepted, you deliver a product to the prospective clients and then help them to take insurance policy. The next is principles of insurance. The very first one is utmost good faith. Utmost good faith. The principles state that the policy taker must be faithful to disclose all relevant facts of the subject matter or particular risk to the insurance company. So it means that whenever you're taking a policy, you should disclose all manner of information that are relevant to the policy to the insurance company. The next one is insurable interest. Insurable interest. The principle states that the insured must have ownership interest in the policy taking. This means that anytime you want to take insurance policy, then it means that there should be a direct interest in that particular policy that you're taking. So in this case, somebody's property you cannot insure as individual, except the product or the property belongs to you. The next one is proximate cost. The principle states that for insurance claim to be effective, it must have direct link with a particular policy taken by the insured. It must have direct link with a particular policy taken by the insured. The root cause, that's very essential. This means that if you take fire policy and anything arising from fire, insurance company will come in. If you take fire and anything arising differently from fire policy, they will never come in. Then subrogation. Subrogation. The principle states that after insurance company compensates the insured, the insurer has the right to sue the third party who caused the damage to claim for compensation. For example, the fire outbreak caused by negligence of the third party. In this case, the insurance company will sue the third party to claim the compensation. Moreover, if there's any leftover property, the insurance company also take the lien over the property. The next one is contribution. Contribution. The principle of contribution states that when one insures the same risks with several insurance companies, the leading company will come together with others, to determine the desirable amount to be contributed to the insured. For example, if the risk surface costs about 10,000, then it means that when there are five companies involved, that the insured took policy from them, then each of them going to pay 2,000, depending if there is no ratio to that respect in terms of the premium. Now, I'm going to consider the basic terminologies or terms in insurance. The very first one is insurer, always the company. Then the next is the insured, the person that being covered by the insurance policy, that the insured. And then we have proposal form. It's a form which the interested person fills by giving details about the kind of policy that he or she want to take with the insurance company. And the premium is an amount of money, either periodic or lump sum contribution made by the insured to the insurance company for a particular risk policy taking. Cover note, we talk about temporal receipt given to a policyholder. The insurance policy also is a contract that spells out the terms and conditions under the insurance. We have reinsurance. This is where insurers share its risk cases with other insurance companies to reduce the impact of huge risk on its financial obligation. Here, the insurance company decides to share part of its risk to reduce the effect of risk and its implication upon the particular insurance company. Then we have actuaries. These are experts who use mathematics and then statistics to reduce the effect of risks on the client. So they use mathematical approach and statistical approach to reduce the effect of risks on the client. Then we have adjuster. They always get to the scene to determine the losses and liabilities of the insurance company. So adjuster determines the cost element of the insurance, the losses and the liability of insurance company. Then we have surrender value. This is the amount of money received as compensation by the insured upon decision to terminate the insurance contract before the actual time. So it means that if the individual decide to stop or terminate the policy, then the insurance company is going to give the person surrender value. The value is actually less than the face value. Then we have arbitration clause. This clause spells out the modality for how conflicts are being resolved on the insurance between the insured and the insurer. Let me first take this aside. The very first one is, what is insurance? Just explain that. And the next is, state and explain four importance of insurance. The third question is, differentiate between insurable risks and uninsurable risks. Please do that and never hesitate. If you confront with any issue, ask question, text me. I'll be there right for you. Thank you. I'm going to continue the lesson. Goodbye.